Thank you very much for taking the time to view our short market video this week. My name is Benoit Poliquin, and this is our second installment, and we are going to share with you a little known phenomenon that is actually quite common in all markets: currencies, stocks, bonds, interest rates, and overall stock market indices. What we're going to talk about today are counter trend reversals. Now, these counter trend reversals really is the idea that what comes up must come down. We've all heard that saying. And we would argue that in the long term, it's the fundamentals that matter. Whether it's a stock, a bond, or a currency, is that asset generating value and increasing this value over time? Is it generating an economic advantage? If that's the case, then the asset will continue to increase. The flip side is, if the asset is losing value, then obviously the long-term trend is down. However, within long-term trends, you can have what we call reversals or counter-trend reversals. And these usually are very violent and quite substantial, say 5% or even 10%. And so they actually can be used for adjustments, if you will. So this, as I said before, is true for stocks, bonds, interest rates, and indices. And as an example, we're going to look at currencies here for a moment. Here we have the 6-month chart of the Canadian dollar to the US dollar. So clearly the trend here is down, and we've basically had this trend where we raised a little bit of a short-term peak here in the middle of October. And since then, we've had a violent down swap, basically 20 cents. But since the middle of January, we've really had a move up of about 3 cents. We reached 73 cents here, we were 68, so about 5 cents. And that's 7% in a very short time, less than 3 weeks. And so even though we have a longer term trend here for the past few months, which has been down, we've had a violent where we basically picked up half of the downtrend here. We rebounded, if you will, in about a little less than 3 weeks. However, over the long term, say over 4 years, the trend is down. Why? Canada's economy is really largely resource-based, and what we have to sell, the world doesn't need as much of. So consequently, our economy, our economic growth or perspective for growth comes off, and the demand for our currency also falls. Within this downtrend, you will see certain uptrends. We see quite violent counter-cyclical rallies, if you will. And so the point here is to remember that they're quite normal, and they actually can be taken advantage of. So in the case of our Canadian dollar example, you don't want to lose the long-term focus that the currency is down. However, you can take advantage of these short-term bounces by adding to existing positions. That could be true of a stock, or if you're trying to sell a stock, you want to take advantage of those bounces to get out of it. So you can use these moments or these violent reversals to your advantage. In this particular example, let's just say you are traveling and you would like to buy some US dollars. Well, you can use this counter-cyclical rally here to take advantage of it. However, don't be fooled. Most people see these counter-cyclical rallies and believe they've hit bottom. Trends rarely reverse. This is very important. Trends rarely reverse in a V fashion. Typically, you will see a downtrend like this, and then you'll sort of see this, it's called a consolidation. It's very rare that you'll see this sort of rebound. Very rare. So market timing is very difficult for all of us, and many get fooled into chasing these counter-cyclical rallies. That is all for this week. Thank you very much for watching. I hope you will get some advantages and mileage out of what you learned today. If you have any questions or comments, feel free to contact me with the information that you see on the slide. Thank you very much and have a great week.